This is a lecture from Open Tuition. To benefit from the lecture, you should download the free lecture notes from opentuition.com.
We're going to finish off our session on group accounts with 3 final points, one of which is quite important. The other 2 you just really need an awareness of. First of all, is it possible not to prepare group accounts at all when you have subsidiaries? Well, there is an exemption. You can see the exemption it says is because something is a subsidiary of another company. And it's really intended for a group like this. P owns S1, S1 owns S2. In those circumstances, it would be pointless for S1 to prepare group accounts because they would just show them to P. So, in those sorts of situations, there's no point in preparing group accounts. So S1 here, in many situations, need not prepare group accounts. The group, this type of group, is called a vertical group. The number crunching for this sort of group is not in the syllabus. If any of you did relevant degrees, you may have met these things. They're just not in the syllabus. So that's why I really don't get excited. You should know the words here, but you certainly don't need to know about any numbers for that sort of group. The second point is the one that is more important. And this is something to do with the parents' accounts. So this is to do with the parents' financial statements, not the group accounts. But if I've got a subsidiary or an associate, then how do I value that subsidiary or associate in my own accounts? There's a choice, and you should know that choice. You can either measure them at cost or at fair value, which after all would be given to you in the question, or using equity accounting. If you've forgotten how to do that, you'll see it again with associates. We know with associates equity accounting, it's that method of accounting. So it's where you bring in the cost of the original investment plus your share of post-acquisition profits. Again, it's not something that's really tested with numbers, barely, but you do need to make sure you know the words. The final one is a standard that came in 2025, IFRS 19. This is something which is associated not with the group accounts, not with the parent accounts, but with the subsidiaries accounts. And in some circumstances with subsidiaries, you don't really need to show as much disclosure as you would in a full set of accounts. Because there are thousands of disclosures now needed, it's a bit pointless to show many which again would only be shown to the subsidiary's parent company. So on the assumption that the subsidiary is not on a stock exchange, and that's the normal situation, then in those circumstances I would not need to make as much disclosure. Again, you don't need to go away and learn a big list of what isn't disclosed. We're just saying the disclosure burden is eased. However, accounting principles are just the same in terms of what we recognise, purchased versus non-purchased intangibles, how we measure cost versus fair value, where we present current versus non-current assets. So that's all the same, but the detailed disclosure in the notes is not needed. That's all that's you need really for those final points in this chapter on basic group accounts. Thank you.